right, everyone, let's get started. Off the top, my name is Claire. I'm here with Dan, our speaker for this evening, and we want to really thank all of you for spending your Tuesday evening with us. Before we get started, I do want to mention that regardless of what device you're joining us from, whether it is your phone or your laptop, your iPad, whatever it might be, you'll have the function of the chat box in the bottom toolbar of whatever device you're using on Zoom. And what we'd love throughout the call tonight is for you to pop through any questions that come to mind. Those questions only come to Dan and myself, so don't worry about any silly questions. There are none, but otherwise we will get started. Firstly, we're going to have a chat a little bit about iBuyNew and who we are. If we can move to the next slide, Dan. We are a specialist agency focusing solely on new and off-the-plan property, which we've done so now since 2008. We offer tailored advisory services based on each individual's own circumstances, and we do that through data, we do that through analytics, we do that through market insights, as well as our own expertise to be able to create a curated project selection for your property portfolio in line with what you as an investor are looking to achieve. We have been operating for more than 15 years now. We've accomplished over 3,000 property transactions. Most importantly, though, and what we're most proud of, is what our clients say about their experience with us, resulting in a 4.9 out of 5-star Trustpilot rating that's come from over 600 reviews up until this point. Who we're for moving forward is really a scope for all investors, starting with first-time property investors really looking for guidance and confidence to know what's what in the property market, because there is so much information out there. Self-managed super fund investors leveraging their superannuation. Also experienced property investors really looking to diversify their portfolio and maybe find other opportunities not readily available, as well as high net worth individuals building high growth and high-end opportunities. Our methodology and how we support clients and how we do what we do is initially evaluate your goals and analyze the market and align those two things together to make sure they work with what you're looking to achieve. We then empower through rigorous analysis to guide strategic high growth property recommendations specific to you. And then from there, it's all about executing on that investment strategy and that investment goal as a step forward for your portfolio. And we support you through this from securing the property right through settlement. But it doesn't stop there. We continue to work through with you with an annual review to look at how is that investment performing to be able to enhance and grow your property portfolio moving forward. How we select the projects that we recommend is a selection framework that you can see here. This includes around 43 points of criteria that we as a business and our board assess to ensure that the key 4 areas that you can see here meet standards and exceed expectations, to be honest. So those things include being a location and where the development is in location, the development itself and the project and what it offers, including amenities, finishes, and everything that comes with it. The developer, and this is a really key one to not only qualify, but also disqualify certain developers or projects because they don't meet those expectations we were talking about. And we essentially do that for due diligence to select properties that perform and we would comfortably recommend to a friend or family member, let alone people like you, the clients that we work with. So essentially, this is who we are, and what we're really proud of is being able to provide education and insights like this evening, which is why you are all here. So on that note, I'm going to hand it over to Dan to really talk through why you're here, tax minimization, what the flow-on effect of that is, and how to use property to do so. So on that note, I will hand it over to you, Dan.
Great, thanks, Claire. And yeah, good evening, everyone. It's good to see a good number of people on the webinar, and I do see 1 or 2 familiar names. So yeah, welcome to tonight. Hopefully you find it useful and educational, if nothing else. So we're going to cover a few things. I'm going to start by just talking about sort of why would you go about building a property portfolio. I'll talk a little bit about what we consider to be the formula of success to really make that work for you. And as part of that, we'll be talking about strategies to reduce your tax, reduce your mortgage on your personal place of residence if you have one, and also strategies to actually boost your super. All these three things work together. So I'll spend a bit of time on that. And lastly, I'll also talk about the differences of investing in new property versus stuff that is established that might be 10, 20, 30 years old. And then a couple of next steps. So a bit to get through. I'll launch straight into it with why would you build a property portfolio? And there's a number of reasons for that. People have different motivations, of course, for different circumstances, but the most common ones that we deal with are people are trying to build wealth for financial security. They're looking to build an income stream through a property or a property portfolio. They're obviously looking for capital growth or capital appreciation over time. Some people have got aspirations to get a certain amount of growth in a relatively short period of time, which might be 3 to 5 years. Others have got much longer term planning goals. But overall, most people are investing in property to get capital growth. Some will do it to get diversification in their portfolio. That might be their property portfolio, and diversification across that in terms of areas, types of property, etc., and the kind of income they can generate. And sometimes just getting diversification in your entire portfolio of investments that you might have, which could include equities and cash and funds. It might be some crypto these days. People are pretty hard into that. It might be your super and the way that's invested. But when you put it all together, it's property portfolio or investing in property can help diversify your investment, your overall investment. It's often to do with closing a gap on superannuation, and what that's referring to is part of your retirement planning. Your super is generally a very big component of that. Some people are really well positioned as they head towards 65, and other people are nowhere, and there's plenty of people in between. And so investing in property can help close that gap. If you someone that you need $3-4 million to hit, come age 65 in terms of net wealth, that is the kind of figure that most people need to be able to live pretty comfortably through retirement years. And that varies for everyone depending on their circumstances and aspirations of what comfortable might mean. But generally speaking, they will need somewhere in that $3-4 million range or more. So some people have got that, and some people will have that when they get to 65. And there's a lot of people that have got a significant gap, and property can be used, investing in property, to start closing that gap. It can very much be used for tax minimisation. And we're going to spend a bit of time tonight talking specifically about that, how property as a strategy, if you get the formula right, can save you a lot of tax. And again, it depends a little bit on your personal circumstances, but that is a key driver for a lot of people. Some people, it's all about creating a legacy for family. A lot of people have deep belief in property, and they want to leave property to their children and to the generation that follows them. And finally, it's generally about financial freedom, because people ultimately want to be comfortable. They don't want to have to work, crazy hours and do multiple jobs in some cases. And they want to be able to retire at a reasonable age. That doesn't necessarily mean, retire at the age of 50 or 55. Some people are quite happy to be working to 70 or 75, but they do want to retire at a certain point in time and do that comfortably. And one of the things, we often find talking to people that it's often a combination of these motivations is why they're investing. And generally speaking, if they don't do something, these aspirations, these motivations won't be met. If they don't do something, and that is often investing in property. If they continue to do what they're doing today, the realisation is that they won't meet their aspirations they have generally for retirement years. So there's a stat that we often quote, which is actually 99% of people do fail. They actually fail to build a property portfolio, and there's a whole lot of reasons for that. But there's some very common ones, and it normally comes down to these things. They've either got insufficient funds, or they think they've got insufficient funds to actually invest. and it's quite often because they haven't structured previous investments correctly. They get distracted. They get sound bites out of the media. They see one little bad news story that's talking about today and not tomorrow and the years ahead. But they get distracted by that. They have a lack of knowledge. They just don't know how to go about it. They get incredibly short-term focused. So rather than being focused on what is this going to do for me over a 5, 10, 15-year period, they're thinking about what's this investment going to do for me today. And that is just the wrong mindset when it comes to property. Property is a long-term game, and that in our mind is between 10 and 20 years. That's long-term. Medium term is 5 to 10 years. Short term is between 1 and 5 years. That's the way we think about timeframes. But if people get very short-term focused, they often don't do anything. They often have fear of just starting, just taking that first step and getting started on something and making the decision. Some people can get very, very hung up on very minor details, and they fail to actually move, and they regret it. We deal with a lot of clients that, or in fact, one of the most common scenarios is people talking to us about their situation, and they say, "I wish I had have done that. I almost did this. I was going to do that if I had have done this over the last 5 or 10 years." And where they are now is quite a challenging position to try and correct in some cases. So just that fear of starting can hold people back. Sometimes they just don't have the right professional support around them. They know what they want to do, but they just need a little bit of guidance from the right team of professionals around them. Some people get influenced by friends and family. Friends and family are trusted, generally speaking. And sometimes that advice is very good and sometimes it's very poor. And when it's poor, it means that people get distracted, they don't do something, they sit on their hands again for another 5 years, and next thing they're priced out of the market. So friends and family can be a distraction. Sometimes they've just got insufficient planning and goal setting, and that's an important thing. It's an important step in the process. Certainly one of the things we talk to clients about is what are their motivations? What are their objectives? What are they trying to do on a 10, 20, 30-year time horizon, depending on what stage of life they're at? But if they're not setting goals, they often don't end up investing in property, don't build a property portfolio. And lastly, they're just not prioritizing it. They're letting every other little thing in their life get in front of it. Now, when you invest in property, it is a significant decision. You don't have to make it the biggest thing in the world, but it is still a significant decision. And it requires you to put a level of focus on it and time into it to be able to make the right decision, to be an informed investor, and then to complete the transaction. And if people are not prioritizing it, they're letting other things that are just the day-to-day stuff, and everyone's got it. There's no question about that. But if they don't make it a priority, it just never happens. So for all these reasons, they're probably the most common things that we see and hear day in, day out as to why people haven't built a property portfolio at the time we meet with them. So a few facts. On a 30-year loan at around a 6% interest rate, you expect to pay 1.2 to 1.3 times the original loan in interest if you don't do anything. So if you let a 30-year loan run, you can expect to pay on $1 million loan, you'll pay about 1.2 to 1.3 million in interest on a 30-year loan. It is an enormous cost. Yes, the bank's money should be used without question, but it doesn't need to be used over a 30-year period, particularly when it's your PPR, your principal place of residency, which has got a lot of interest being incurred that's not tax deductible. I'll talk a bit about that a little bit later on. Second thing is 77% of retirees receive income support, and income support isn't great. If anyone's got parents or elderly people, friends, family that are on income support, they'll know a single retiree receives, on average, in terms of pension, $1,096 per fortnight, and a couple receives, on average, a pension of $1,653 a fortnight. It is in today's cost of living, it is not a lot of income to be on, and you do not want to find yourself in that situation where you're relying on a pension. And that's what unfortunately a lot of people, 77% of Australians at the moment, still rely on that when they get to retirement age. And lastly, 50 to 70% of typical Australians, their gross weekly income goes towards fixed bills and living expenses. So it's a lot of their fixed wages every month. It's going straight to that. And if they're not doing something, not being proactive about it, they're not actually having enough money to be able to build wealth, to actually accumulate wealth over time. It's just going, a lot of it, 50 to 70% of it, just going into day-to-day expenses. So I want to talk a little bit about what we consider to be the formula for success. If you get this formula right, it'll enable you to do a number of things I'm going to come to in a minute, but saving tax, reducing your mortgage, and actually boosting your super over time, it will enable that. But you must get this formula right. And the formula is not complicated. Firstly, you need to use leverage. You need to use the bank's money. You need to use debt when you're investing in property. And I'm not talking about your principal place of residence. I'm talking about a rental property, investment property you're going to hold for investment purposes. People that are not using debt, they are not getting the right outcomes. They're putting way too much capital into it, and they might be able to do one investment or two, but they will not be able to build a portfolio, generally speaking. So you need to use leverage. You need to maximize the LVR, so the loan to value ratio needs to be maximized. And what that's referring to is, you hear lenders talk about or brokers talk about an 80% LVR or 90% LVR. That is 80%, you're talking about 80% LVR on $1 million property, that's getting a loan for 800,000. You should maximize that. And you can get an 80, 90, 95% LVR. In some cases, you can get 95% LVR. The days are gone of really getting 100% LVR, but you can get in some cases a 95% LVR, and you can absolutely get a 90% LVR. It means you will pay LMI. And a lot of people are scared by that. I'm going to come back to that in a minute, but it is absolutely worth going for a maximum LVR and then setting that loan up on an interest-only basis. Now, that doesn't have to be for 30 years. In fact, you won't get it for 30 years, but you can go and set up a loan up front for a 5-year period on an interest-only basis and then renew that on interest-only every 5 years. And that is our recommendation. I'm going to explain that. I'm going to show how the numbers work a little bit later on. But that's the first part. You must use leverage. You must max out your LVR, and it should be on an interest-only basis. The second thing is you need to invest in new and off-the-plan property to maximize your depreciation deductions. So when you think about negative gearing, there's two big components. There's the interest deductions you're getting on the debt that sit alongside your investment property, and then there's depreciation claims. Everything else, all of your other deductions to do with repairs and property management fees and council rates, body corporate fees if they apply, all of that stuff is tax deductible, and it goes into the pool of deductions you're claiming against the investment property and creating that negative gearing, reducing the tax. But these are the two big buckets. And if you don't get both of these right, you will not maximize the negative gearing. So the first bit is get the leverage right, use debt and max out your LVR. The second thing is invest in something that's new. And I'm going to spend a little bit more time talking about that in a minute, but the difference is huge. And I'm comparing that to, say, established residential property, something that might be 20, 30, 40 years old, whatever it is going to get you very, very minimal depreciation deductions. The tax office allows you to claim depreciation over 20 years on a property. You can write down the capital value of the building over 20 years, 2.5% a year. You can also write down the fixtures and fittings that are within the home. So all the appliances, the flooring, the blinds, the air conditioning units, blah, blah, blah. All of that can be written down, depending on the item, over a much shorter period, between 3 and 15 years, depending on the item. The tax office specifies that rate per item. When you put those two things together, that's the depreciation claim that you will get each year in your tax return. And when you submit that, if you're doing that on a new or off the plan property, when you submit your tax claim for that, it'll often be between 20 and 40,000 a year. Very significant depending on the property value. If you do it on an established property, it might be $1,000. It may be zero. But the point being, if you're not doing these two things, you won't be getting the optimal negative gearing. You won't be maximizing your cash flow. So that there is the secret to success. If you get that formula right, you will do as an investor extremely well. And I'm going to show you a few numbers on that in a minute. When you deploy that formula, it enables a number of things. It firstly enables you to reduce your tax. So what you've done by doing that is you've created this negative gearing. You've created a pool of tax deductions against a rental property that can be used to offset the income you're otherwise paying tax on. So a typical salary and wage earner earning more than 190,000 a year, they're paying top marginal tax rate. At a top marginal tax rate, they're paying 47.5 cents in the dollar. They're almost losing half their income. If they've got a rental property, an investment property that has been structured correctly, they've selected it correctly, they've got the loan set up correctly, they've picked something that's new and off the plan. Once that settles and it's been deployed and it's working for them, they will often have deductions of 20, 30, 40,000 a year, depending on the property. Now let's just say it's $30,000 a year and their top marginal tax rate. Straight away, they're saving about $15,000 a year. So it's enabling them to minimise their tax, to reduce their tax. And that becomes extremely powerful when you've got 3, 4, 5 investment properties. If you've got one, yes, it helps. But where it has real impact, particularly if you're a top marginal tax rate payer earning $250,000, $300,000 a year, either as an individual or combined, that's when it becomes extremely powerful. You can start to save a lot of money. I'll show you some numbers in a minute. So the first thing is it can minimise your tax. The second thing is, as you start to minimise your tax, it's creating more after-tax income. So your after-tax income goes up, and that enables you to do a number of things. You don't have to do this, but if you've got your principal place of residency has got debt on it, and that debt is not tax deductible, first thing you should be doing is putting that excess cash against that PPR debt. Start paying that down much quicker. And the sooner you start to do that, the less interest you're paying. So rather than paying, the example I used before on $1 million loan, over a 30-year period paying $1.2 to $1.3 million, you can reduce that dramatically. And you can pay down your loan much, much quicker. So if you start to use those tax savings to pay that down, that's one strategy. Second thing is that once you've paid down your PPR debt, or if you don't have a principal place of residency with debt against it, it's unencumbered, you can actually start to use some of that cash flow to maximise your super savings, your super fund. So you can put additional contributions into your fund. I'm not going to dive into that. We have a separate webinar that talks about super and growing your super and using super to invest in property as well. That's a completely different topic, and it's quite a detailed topic to get into. So look out for that. You'll see some communication on the next time we talk about that. But that's another thing you can start to do. You can make additional contributions. If you structure those correctly into super, they can also be tax deductible, and you get this circular effect where it continues to reduce your taxable income. You can also do pre-tax super contributions. So there's a few things you can do there, but that's actually for a separate webinar and conversation. So this is what, if you get that formula right, this is what it will enable you to do. Now, I just want to circle back on one thing I touched on a little bit earlier, and when I referenced LMI, if you go above an 80% LVR, you will start to incur LMI. So in this example here, just showing you someone that they've got 100,000 in cash or equity. They've got 100,000 that they can invest in property. Now, if they invest that 100,000 and they do an 80% LVR, it means that they've got to put 20% equity plus cost. And when I say plus cost, that's basically the stamp duty. The stamp duty is the single biggest cost. It varies a little bit by state around the country, but let's just call it, on average, 5%. So when they put in 20% plus the 5% on stamps, their full deposit or the full equity they've got to put into the deal will be 25%. It means that their buying power is only 400,000. 400,000, pretty hard to find an investment property anywhere in the country, outside a couple of very remote regional areas that we wouldn't be recommending. Let's say someone did. If they've got 100,000, they did 80% LVR, they pay the 5% stamp duty, they're going to have purchasing power of about 400,000. Now, on a very modest capital growth rate of 5%, across Australia, our average long-term capital growth rate is 7%. But let's just run it on 5. On 5%, it means the capital growth they would get on this property would be 800,000. Now that is over a period. Let me get the math right. That's a period of 20 years. But over that period, they pick up 800,000 of capital growth. Now let's just say they do a 90% LVR. So rather than do an 80% loan, they do a 90% loan, and they incur $10,000, and that's roughly the fee they would incur. They would incur a $10,000 fee, LMI fee. What their true deposit becomes 15%, but their purchasing power all of a sudden jumps up to 666,000. 666,000 is much more realistic to be able to invest in property and good property, and really north of that. But 666,000, you can definitely get a good investment property. And on a 20-year basis, it would grow to 1.3 million on a 5% growth rate. Okay, so that's the second scenario. The third scenario is they truly max out their LVR. They push for a 95% LVR. Now, not everyone will have the serviceability to do that. They will generally be able to do it between 80 and 90%. Some will be able to get to 95% LVR. On a 95% LVR, the LMI jumps up to 25,000. Purchasing power jumps to $1 million. On $1 million, at a 5% growth rate, you're getting to $2 million capital growth over 20 years. The question is, would you pay $25,000, pick up incremental $1.2 million of capital growth? It's a bit of a no-brainer. I don't think most people would deny that. A lot of people are scared of LMI. They think LMI is a bad thing. They've been told by friends or family or other people not to incur LMI. It should not be something to be scared of. It should be something to actually embrace and incur that LMI, because it increases your purchasing power, and on a long-term basis, it will maximise your wealth creation, provided you invest in the right property. So that's just a little bit about leverage and maximising your leverage. The other thing about leverage is that if you do that, you've got more capital. So let's say that example before, the person didn't have 100,000, but they had 200,000. Now they could just go and do an 80% LVR and get one property done. But if they went and did a 90% LVR, they can get 2 or even 3 properties done, and they can very quickly build their portfolio. That's one of the keys. That's one of the keys to success here. You need to be using your equity, the cash that you've got, the capital that you've got. You need to use that very wisely. So what people tend to do, these are just some stats. These are ABS, Australian Bureau of Statistics stats. The number of people in Australia that own one investment property is 71% of the population, adult population, that is. There are only 18% of the adult population that own 2 investment properties. There's less than 6% that own 3. There's 2% that own 4, then it drops. There's less than 1% of the population, the adult population, have got 5 or more investment properties. Now, they might hold 2 or 3 properties, but they're actually quite high value properties. The average investment property value is around 640,000. It's actually a relatively small number. So normally speaking, if they're only holding 1 or 2 investment properties, it's not going to get them to a point where they've got $3-4+ million of net wealth accumulated at retirement. Most people need 3 or 4 properties, 5 in some cases, depending on what stage they're at and what they're investing. But if you want to be building a portfolio, which for all those reasons we talked about at the start, is why a lot of people do want to do that, they need to get this formula right. Otherwise, they just won't have the capital to do it. They've really got to use the bank's money and leverage up properly and structure it correctly to be able to do that. So just coming back to minimising tax, provided you get that structure right and you're getting the negative gearing effect working for you, it's going to allow you to reduce your taxable income. You're going to have the depreciation claims, the right level of interest deductions and your holding cost and all the other costs. That's going to be maximised to be able to create these tax savings. You do need to structure it correctly. And your personal circumstances may be a little bit different. But a lot of people that are PAYG income earners, normal salary wage earners that are having PAYG deducted by their employer, if they go and structure this incorrectly and they go and set it up in an entity, the investment's in an entity that's not in their own name, it won't work for them correctly. It will not save them tax. That often comes up, in conversations with people where they've gone and made the wrong decision or they've taken bad advice. The other thing is that when you're a couple, a married couple, it needs to be considered which name the entity or the investment goes into, whether it's your joint names or one or the other of the couple. And that's where understanding your taxable income, your tax position, and other investments that you own is really important, and getting the right structuring advice on that right up front before you make the investment. Because once you've made the investment, you can't unwind it. It's very difficult. Then also understanding the timing of buying and selling between tax years is also another really important consideration when you're thinking about tax and tax minimisation. I'm not going to dive into all the details of that, but if you're talking to me or one of our investment strategists, it is one of the things we'll talk to you about the timing of when you make the investment and also the timing of when you might sell or recycle assets within your portfolio. Getting the timing of that is hugely important, and it depends on your marginal tax rate in that year, other events you've got going in that year, and also just thinking about the timing of when you may pay capital gains tax. It's always better to sell a property in July than June, for obvious reasons, because you're going to defer the tax by a period of a full 12 months if you do that, a period of 13 months actually. So timing is a very important thing. Coming back to leverage and negative gearing, if you get these things, if you get that structure right, you will maximise your negative gearing. It's going to enable you to reduce the tax you'll otherwise pay on your other income, and then you can start to use some of those tax savings to either pay down your PPR, boost your super, or enhance your current portfolio, as in save that money and get a deposit ready for the next investment. So I'm just going to bring up some numbers and just talk through. There's a lot of numbers on this chart here, but the reason I'm bringing this up is just to give you an idea of how you can go about setting up an investment that does minimise your tax, but it doesn't mean you need to have negative cash flow. A lot of people think that negative gearing means negative cash flow, and it's not. You can actually have negative gearing and still have positive cash flow, and this is an actual example of that. Now, there's a lot of figures on this chart. This is exactly what we provide to clients when we're making a recommendation. We take them through a 10-year projection model. The top of this chart here, these top sections here, is just the capital value. This was an $850,000 investment. It's growing at 7%. By year 10, it's worth $1.6 million. That's the equity, that's the capital gain. This is the loan value. So this loan, they've got a 680, this is 80% LVR. They've got a loan set up at 680,000 on the interest-only basis for 10 years. It would have been on for 5, and it would have assumed they roll it over for another 5. So the loan value doesn't change. This shows you their equity position through the loan. And the bottom section of this chart is really just showing you the rental income and the cash flow. So that's the rent line there. You can see the rental yield, it's good. Starts at 5.1%. A lot of our recommendations sit between about 4.5 and 5.5. We probably won't recommend it if it's not in that range or above. At 5%, growing with the rental value growing at 5% per annum, you can see the yield over a 10-year period is getting up to 7 or 8% on a gross level. These are the interest deductions. These are all the other property deductions. And if you cut down to here, this is showing you then the depreciation on this investment property. One, 850,000, they've got almost 30,000 of deductions on depreciation year one. So when that gets put together with all the other deductions, the interest and all the other holding costs, you've got $72,000 of total deductions. It's creating the first year, if you just look at the first 3 years, it's creating a tax deduction against their other income of $28,000, $21,000, $17,000 those first 3 years. On top marginal tax rate, they're getting back $13,000, $10,000, $8,000 in tax. This particular property, if you just ignore the tax effect of this and the depreciation, and just take the total income, $43,000, the total deductions, $43,000. In year one, it's basically break even. It's slightly positive. In year two, you got $46,000 of income, and you got $43,000 of cash deductions. You've got positive income of almost $3,000 in that year. It jumps to $4,000, $6,000, $9,000, and so on. At the end of the 10-year period, this is actually a very decent passive income this property is generating in terms of just cash flow, $22,000 a year before tax, $17,000 a year after tax. So that bottom line is just the after-tax effect. I won't double count that, but hopefully that just gives you an idea of how, if you get the structuring right and the property selection right, you can have a positive cash flow investment that's not costing you any money to hold the property from month to month, year to year, but it is giving you those tax benefits to actually reduce your taxable income. So in that particular example, over the first 5 years, just the first 5 years, this person saved $41,000 in tax. They created a passive income stream of $25,000 during that period. That they reduced, they created enough income through the positive income and the tax savings to reduce their PPR debt by $66,000 over that period, those 5 years, before any tax savings. They accumulated $390,000 in capital appreciation. Now, they haven't gone and sold that property, but they've accumulated $390,000 of appreciation on a 7% growth rate. And they've actually built, by year 3 or 4, they've built enough equity in that property to go and rinse and repeat, to go and draw on some of that equity. Don't even put any more cash into the next investment. Just draw on 80% of that equity and invest in the next property. And that's what a lot of clients are doing to build a really, really solid portfolio of investment properties over a period of time. The other thing, just to highlight, is that over 10 years, they've reduced, in this example, their PPR debt by some $200,000. That is enormous. Depending on your situation, you may only have a PPR debt of $500,000. You've straight away, over a 10-year period, reduced it. Before the other loan repayments you will have otherwise made anyway, you've reduced it by $200,000. It has a huge impact on your long-term wealth. The second is that point to call out is that this is actually done under an 80% LVR. So with $185K invested in that example of an $850,000 investment, if they had pushed the LVR to 90%, even with a $15,000 LMI charge, they will have got the same outcomes or better. The same outcomes or better with only $100,000 invested. So rather than having 185 invested, they could have just had 100,000 invested on a 90% LVR and got pretty much the same outcomes or better. So that hopefully just gives you an idea of how the numbers will typically work if you get this formula right and you deploy it correctly onto the right investment. The last thing I want to just spend a couple of minutes on before we open it up to a little bit of Q&A is just on the difference between new and off-the-plan property versus established property. And I'm talking about residential property here as opposed to retail or commercial or any other property. But there's a number of things about new and off-the-plan property that are not well understood. Now, I did talk about the depreciation deductions before. I'm a former chartered accountant. I think some people I know on this call, they know that. And I'm a little bit biased probably as a result of that. But the depreciation deductions you get off a new property are massively powerful in terms of saving tax. It's the single biggest deduction you're going to have alongside the interest. So that's the first thing. I'm not going to repeat that, but there are a number of other things that are very, very important as an investor to be mindful of. The first is the rental yield. So we tend to, and you saw that with an example before, that was based on an actual rental appraisal. They're getting a 5.1% gross rental yield. When we look at established property and we look at clients' portfolios that come to us, where they've got some established property in there that might be 10, 20, 30 years old, whatever it is, it's often sitting between about 2.5% and 3.5% rental yield. An older property does not command the same level of rent that a brand new property will command, and therefore the yield tends to be much lower. So that's the first thing. The rental yield is generally much higher. And if you want to get that formula right of getting positive cash flow, but still having negative geared property, you need to have very strong rental yield. You need to have around, on today's interest rate, you need to have between about 4.5% and 5% rental yield. The second thing is you'll have very little maintenance costs, particularly over the first 5 to 10 years. Now, beyond that, of course, the property starts to incur some wear and tear, and things can start to break down and need fixing and repairing. But generally speaking, in the first 5 to 10 years on a new property, it'll be very minimal. All of our projections, we always put a figure in, normally $300 to $500 a year over a 10-year period. But it'll have, compared to something that's established, it'll have very low maintenance cost. The third thing is that, and it's very important in today's day and age, but all of the new developments, they need to be compliant. They need to be highly energy efficient. They'll also be fairly tech enabled, but which will help with the resale value on properties. But the energy efficiency is incredibly important, and there's some new legislation that's going to be coming out. It's getting rolled out over the next few years. It's going to make this even more important. It's going to cost people a lot of money to hold investment properties in the years to come that are old, that are not energy efficient and not 7-star rated. It's going to be a huge step change in the industry, and that's progressively going to roll out over the next few years. The next thing is that the growth that you can get of something that's new and off the plan with only 10% down is very significant. If you're buying an established property, you've got to have your full 20% minimum on an 80% LVR at least, full equity invested right up front. You can get into the market on something that's going to settle in a year or two, and let's say it's 2 years' time, you're only putting down 10% now at today's prices. And over a 2-year period, if it's invested correctly, you are picking up gains over a 2-year period with only 10% down rather than having the full 20% plus cost invested right up front with something that's established. And lastly, you've got some potential stamp duty savings. Now, in each state that varies and the rules vary, but there are a number of scenarios at the moment, and that'll ebb and flow over time with different policies in different states. But there are scenarios where you can save on some stamp duty. And combined with all these other benefits, it's a little bit of cream on top. Now, just if you think about the flip side, the downsides of established property, I'll kind of cover this off a little bit, but they tend to have much lower rental yield. The repairs and maintenance are generally much higher, and they have genuine hidden costs. We talk to a lot of clients. I've been through it myself, where you just get hit with next thing like a $15,000 bill to restump the home, or a $10,000 bill to replace the hot water system. These kind of things can come up, and they come up on a semi-regular basis with older established properties. Next thing is the minimal no depreciation claim. As I said before, this is the single biggest thing. If you do not get this formula right and you invest in an established property, particularly something that's 20 years old, 30 years old, 40, whatever it might be, you will have virtually no depreciation. When you get a quantity surveyor to do the evaluation, you get a depreciation schedule on an established property. It might have a small number of fixtures and fittings that are not fully written down. That might get you a couple $100 of depreciation deductions, might get you $1,000. But generally speaking, it'll be very little. So if you're investing in established property, you'll find that your negative gearing is nowhere near what it would be versus something that's new. Also, as I said before, you've got to put your full equity in up front with something that's established, because you're buying it typically as a private sale or an auction. And when you're doing that, you've got all your money locked up front. And then lastly, there are no concessions around stamp duty. So you will pay full stamp duty. Obviously, that varies a little bit by state, but buying established, there are no concessions where they are on some new and off the plan. So Claire, that was probably all I was going to cover now. I think you might cover a few things, and then we'll open up to some Q&A.
Yes, absolutely. Thank you, Dan. Obviously, guys, that was some great information. Maybe overwhelming, and that's totally okay. That's actually why we're here, to simplify all of that. But hopefully, regardless, you've really understood the roadmap moving forward. And now it's really about making that relevant to you and your goals. So before we get into the question and answer, a reminder, you can still post questions in the chat box that you should. I'm just checking everyone has access. Yes. So we do have some questions already come through, so we'll get to those in just a second, Dan. But what you can do is scan the QR code on your screen. I'm also going to post the link in a second, which really just is an opportunity for everyone on here to express their interest that, yes, I would like to continue a conversation about what the next step of investing in property and doing all those things that Dan spoke about with tax minimization, and what that means for our mortgage, what that means for our super, and really getting the ball rolling. So feel free to scan that. I'll post the link in just a second. But let's look into a couple of questions if you're ready, Dan.
Yep.
There is one that's come through that says there was a reference to potential stamp duty savings. I assume what we just went through. Can you elaborate on what they might be for something that's off the plan?
Good question, and it is a little bit challenging to answer it specifically because it's very state dependent. Stamp duty is a state tax, as most people would know, and each state has different rules and policy to do with stamp duty. Some have got some concessions at the moment. So one, for example, is in Victoria. If you're investing in something that's off the plan in Victoria at the moment, apartment or townhouse specifically, you will be eligible for the stamp duty concession if you sign a contract between now and October 2026. That concession's been available for 12 months. It's going to be available for full 24 months. It's almost exactly to today. I think it's the 18th, of October from memory, that runs to next year. But if you're investing in any, it doesn't matter if you're an investor, owner occupier, whatever type of buyer you are, whatever type of property value, at the moment, the Victorian state government is offering a stamp duty concession. It means that you only pay stamp duty on the land value, a maximum of 25%, or the land value. So if you say on a say $1 million investment, just to keep the numbers simple, normally you would have paid $55,000 in stamp duty in Victoria. It's 5.5%. Under the current concession, you will pay an absolute maximum of about 12,000. But depending on the method that is used by the developer, as long as they use the specific land allocation method, it'll normally be a few $1,000s. So rather than paying $55,000, you'll pay about five, something like that. It varies by development and developer. So that's a huge saving. Another example of stamp duty concessions is, say, with I'll just use townhomes as an example. If you're investing in a townhome that's pre-construction, you will only pay that there is a judiciable value you'll pay on. That will just be on the land component. If the townhome is half built, you will pay on the land value plus half the construction value. So you are not paying on the full contract price. You will pay on what's called the judiciable value. It does vary a little bit by state, but generally speaking, that's quite common. So there's a couple of areas, Claire. I hope that helps.
Yeah, very much so.
A couple of examples of where that stamp duty concession for new and off the plan property can help.
Yeah, absolutely. Another question, we've got a few that have come in, so we'll keep moving. Another question is, I've been told to buy property in a trust and it's going to be negatively geared. Have I done the right thing here?
Investing in property in a trust. Yeah, that's potentially problematic. Whoever's asked that question, I'd suggest you actually do book in for a strategy session, because it will depend a little bit on your personal circumstances. If you've got no other assets held by that trust, it could be a problem. And what I'm referring to there is, if it's negatively geared, a trust cannot distribute its tax losses. Those tax losses are locked in the trust. The trust is not a tax-paying entity. It just flows through income to taxpayers, either individuals or companies. But so income, taxable income is distributed, but tax losses are locked in that trust. Now they accumulate. So down the line, if you've got a capital gain or you've got other income, they're not lost. But in terms of using, if you're trying to use negative gearing to reduce your tax, it will not help because your income, it depends. That's what I'm saying. Whoever's asked that question, they're better off booking in for a session with me or other investment strategists. But it will depend a bit on your circumstances. But there's a fair chance if you've got other taxable income, you're a PAYG earner paying tax in your own name over here. You've got your trust over here that's got the couple of properties that are negatively geared. That negative gearing cannot be used to offset your other income over here to reduce your tax. It's locked in there. And that would be a problem. There's potentially some strategies around that, but they are complicated and not where you want to be. So that is not something we would advise under that scenario. There could be some other good reasons for doing it, but if the negative gearing was originally designed to reduce tax, we wouldn't normally advise for that.
Yeah, perfect. Another one that has come through, which this is a great question because it is a lot of people's concerns. What happens if you buy off the plan? So let's say you don't even start construction yet, or construction goes on for a couple of years. What happens if you buy off the plan and the builder goes under?
Yeah, it's unfortunately it has happened from time to time. It's actually extremely rare, but the reality is that it has happened, and when it does happen, it gets quite a bit of publicity. So it probably amplifies or makes it feel like it happens more often. It's very rare. Having said that, it can happen. It's a risk, and you need to mitigate that risk. It is one of the key things. Um, I'm one of the two directors of iBuyNew, myself and Andrew. We spend an enormous amount of time looking at developments, assessing developments, understanding the developer, their team, including the builder, to make sure that they've got the right track record, they've got the balance sheet, the balance sheet strength, and they've got multiple projects they've delivered and proven themselves to be someone that is going to deliver time and time again. If you get the selection right, that risk is super low. But if you don't do the diligence or don't work with someone like iBuyNew that's actually done the DD on those developments, then it's a risk. Now, when that scenario unfolds, in theory, you should be okay, as in your deposit should be sitting in a trust account. It should not be, but it does depend a little bit on what stage the project's at. But it's certainly a risk. It can be very, very much mitigated if you get the selection right, and that's something I think we add a huge amount of value in. But hopefully that answers it, Claire. That it's a relatively small risk, particularly given that your deposit should be sitting in a solicitor's trust account, and it can't be accessed until completion.
Mm-hmm. Yeah. So due diligence is really important. That obviously, as you touched on, Dan, that's a big part of the selection framework that we spoke about earlier. So that is what we look at, is the track record. Let's chat through one more question, a very exciting question. How much do you need to start investing? I'm assuming this is how much cash upfront do you need to start building your investment portfolio?
Yeah, it's a good question. And just broad brush, it's about those figures we had up on as an example before are actually reasonable. It's about 100,000. There are some scenarios where someone doesn't have a huge amount of cash, but and I'm talking about either cash or equity, right? So you don't have to necessarily have cash. If you've got 100,000 of equity, you can get started, but it depends a little bit on your serviceability and whether you can get a decent LVR, and then what we would actually recommend. There's certainly properties that we can recommend that are in the $500,000 to $600,000 range. We've got a couple of recommendations at the moment that are high 400s. That's very bottom end of the range, anywhere in the country. But we have got stock at that level and some recommendations at that level. So if you've got 100,000 of either cash or equity, you can definitely get started. And there are a few scenarios where it can be a little bit less than that, but there are other considerations like your income and your serviceability, and other kind of assets and liabilities you may have.
Perfect. And I think just to touch on that as well, it is case by case, and having a discussion with us will help figure out what are the strategies, whether it's assets, whether it's, things like deposit bonds, maybe there's lots of different solutions that people can use to be able to get their foot in the door, which again is a personal conversation based on your own circumstances that we will absolutely look forward to having with all of you. So on that note, we do have some other questions coming in, but what we'll do now that we're finishing up is make sure that one of our team members gets back to you and talks about those questions based on what you're looking to achieve and your own personal circumstances. You'll see in the chat box that there is the link to express your interest to continue the conversation with Dan or one of our other investment specialists. But you can also scan the QR code there. Other than that, we thank you for spending your evening with us, and I'm very, very confident that with what Dan shared, you feel more clear and more confident about moving forward with your investment goals and building your portfolio. So other than that, we look forward to speaking with you very, very soon, and hope you have a great evening.
Thank you, Claire. Thank you everyone for joining. Hope you enjoyed it. Thank you.